Hello Ichimoku traders, Chris Capri here, secondsguysforex.com. So this is a new video on for 2016. I talked about doing 3 new videos. This is the second, so the last one was on intermediate wave theory. And this one, we're going to split into 2 videos because I realized that there are so many different concepts and methods and ideas in here that are going to take time to practice that I wanted to split it up. So we're going to split it up into 2 parts. And so this is on price action, Ichimoku price action theory. Now, many people, the greatest misconception about Ichimoku out there is that the majority of what Ichimoku about is on the 5 lines. And the next misconception is out there about Ichimoku is that the only thing the Ichimoku about is 5 lines plus 3 pillars. Well, in actuality, they do have price action theory and price action methods actually built into Ichimoku. In fact, the 6th chapter in the Hidenobu Sasaki text is all about Ichimoku price action theory. So we're going to be getting into the intro concepts to that, the beginning concepts of that, and kind of explain it, the terms, the terminology. First thing I'm going to do is I'm going to actually move over towards something that I taught, which is impulsive and corrective price action. Now, most of you probably already know this. If you don't, go ahead and read this article. Just search for Understanding Impulsive and Corrective Price Action on my website. There's a little search function there, and you'll find this main article. You don't need to know these terms to do this course. However, if you knew them when I mentioned the terms, you'll understand. I will be mentioning them more and more. But so instead of me doing an entire video on this, because I could spend an entire video talking about this, for those of you who don't know this, just go watch the video or go read the article, and you'll have the core concepts down. And the main thing you just need to focus on is, what is the basic idea behind an impulsive and corrective move? What's the basic idea behind them, and what do they communicate in terms of price action? Okay, so with that being said, let's go ahead and dive into Ichimoku price action theory. So I'll start off by talking about the first core component of, I don't want to say underlying theory, but the first core, I guess you can say, tactic. We should call it a tactic in terms of using price action, Ichimoku price action theory, to help us understand what is happening in the order flow and how it can relate to the other Ichimoku elements. Now, you notice I have a bear chart minus a 20 EMA here. I should actually, technically, I could turn this off. So let's go ahead and do that. I have a bear chart of just price action, and I thought I would do this because it will help to understand the basic concepts so you can kind of see them naked as they are, so that when you apply them with Ichimoku, you already understand the basic ideas behind it. It can get very confusing if you're looking at all these fine lines, and I'm trying to explain the concept here. So we're going to start off by talking about Kifu and the 5X rule. And understanding its tactical applications for understanding a trend or a trend reversal. And then we're going to talk about an intercept bar and what that means. And then we're going to talk about a limit line. And the limit line, when I introduce it, you're going to be like, oh yeah, I know that concept. It's this. It's something you've probably already worked with. So let's go ahead and start off by talking about Kifu. So Kifu comes from 2 Chinese characters. The Japanese word for Kifu comes from 2 Chinese characters. It means, the first part of it means pattern, the second part of it means symbol. Both of them together mean shape. And when you think about it, you know, what is Ichimoku trying to discern? It's trying to understand the imbalance or the level of balance or equilibrium in the order flow that is represented in the price action. So they've hinted, hey, this is what we're trying to understand. This is what we want to know. We do it through the 5 lines and the 3 pillars, but we can also do it through the price action as well. Price action was meant to be studied with Ichimoku, and Ichimoku was meant to be studied with price action. They're meant to go hand in hand. And so, as I mentioned before, Kifu split up into two words, pattern and symbol, both of them mean shape. Now, there's a term you don't really need to know it, but Goyo-ren, which equals 5 bulk candles, and Ren equals sequence. Now, so just understand that part, 5 bulk candles and sequence of them. Basically, 5 bulk candles in a row. Kifu in Ichimoku terms is equivalent to a sequence of 5 bullish or 5 bear candles in a row on a daily chart. They didn't talk about intraday time frames. They just talked about on a daily chart. So for now, we're going to be playing on a daily chart. And so Goyo-ren is 5 bulk candles in a row. Now, according to Ichimoku theory and in Kifu, anytime you see 5 bulk closes in a row, it generally signifies a change in the sentiment, especially if we've been in a bearish type environment or bearish type context. And the same would be vice versa. If we were in a bullish context and all of a sudden we were to see 5 bear candles in a row, then that would generally hint or intimate that this bull trend is over and that a new bear trend or bear move is starting and it's underway. The ideal definition of Kifu for them in 5 bulk candles is if the candles are relatively small. They're not super large candles like, like this. They're not all like this or like this. Ideal is if they're kind of like this small type like this. Now, generally, we are only looking at Kifu for now until we talk about the part 2 and what that means in terms of a trend. But generally, you should just think of these as reversal type mechanisms. That when we see these, say at the bottom of a move, particularly at a support area, or maybe it's like we have an A, B, C, D wave or something like that. If it's A, B, C, and all of a sudden we start to see at the bottom, or A, B, C. If we come to D, it stops there, and we start to see 5 bulk candles. Then we look at that as a potential reversal. And there are going to be some other components to look at, but that would be indicating to us, hey, there's a good chance that this thing is reversing. Same thing with the bear move. So we're generally looking at these at key tops and bottoms. If they start to appear at key tops and bottoms, then we should be on alert. That is kind of the main communication that Kifu is really trying to communicate. Now I'll talk about the most common formation that in all the Ichimoku charts I looked at, which are all in Japanese, but I could understand what they were talking about. When I looked at all the examples, there was a very common formation or pattern where Kifu emerged the most, and we'll talk about that. But let's just talk about the basic idea behind Kifu. So if we were to have, and we're just going to really be talking about Kifu and wave theory in this section here. So if you look at the general wave structure, what do we see? We see an A, B. This is a weak one here, so I would almost consider this pullback here one leg, like B to C. So let's say we have A, B, C, D. Okay? Now, we get a bounce, and in this wave structure down, this would just be A, B, C, and then we'd be looking for another leg down. However, the market really forms kind of a double bottom here. Actually, it's a higher low. And then what do we see? We see 1, 2, 3, 4, 5 bull candles. Now, this is a little bit larger than I generally like them, but what's the idea behind this? Look, if we have an A, B, C, D structure and the D fails to make a new low below C, that should be the first indication by a wave structure, hey, something's amiss here. Now, if the market just went back to here and then sold off, then that would be okay. But it didn't. And what do we see? We see 1, 2, 3, 4, 5 bull candles in a row. So what an Ichimoku price action trader will be looking at this saying, look, we have a failed wave structure. So that's context that is supportive of a potential reversal. And then we have 5 bull closes in a row. Now, if you think about it, 5 bull daily closes in a row, that is Monday through Friday. That could be, Tuesday through Monday. That could be Wednesday through Tuesday, Thursday through Wednesday, Friday to the following Thursday. That's a lot. Either way you slice it, 5 daily bull closes in a row or 5 daily bear closes in a row. That's a lot of days to consecutively be moving and closing in one direction. That should by default start to intimate, hey, wait a minute. This is happening against an already bearish structure? That doesn't seem to make sense. If you were to count all the bull candles from here to here, it's like 2 out of every 3 candles is bearish. And then all of a sudden we get 5 bull in a row. That's out of place. That's odd. That shouldn't make sense. We shouldn't get that much inside of a general bearish structure. So we already have a wave structure that's been violated from this A, B, C, D. D not making a new low, not even making the same low. And then we have 5 bull candles in a row. This would be considered a 5 bullish Kifu here, so our 5x Kifu. And Saxo Bank has this great tool called the measure. Now, what's the general pattern behind Kifu as a whole? That you measure the height of the 5 bull candles. 1, 2, 3, 4, 5. And that what you should expect is that if the supporting context is supportive of a Kifu, if the wave structure has been violated, then we should be at a minimum expecting one more move up from this Kifu here. And then we should at least expect a move to be as large as the Kifu itself. Very rarely do we get the emergence of a Kifu that breaks a wave structure that is supporting context and doesn't produce a move of equal size. In fact, the irony about this is that at the same time I was studying Kifu, I was sitting it was at the Intercontinental in London back in 2011. I was talking with an FX trader. He manages about 50 million. And we were having this conversation about, changes in trend momentum. And he said an interesting statement to me. He goes, generally, I've noticed that anytime I've seen 6 candles in a row of the same color, 2 things should be happening. 1, I shouldn't be trading against that. 2, I should be trading with it. We were just talking about various patterns. I was like, wow, that's an interesting way to look at it. I hadn't thought about I had thought about it, but, so eventually I started to test this idea and I haven't been able to kind of make an algo out of it, but there is a tremendous amount of credence to the idea that if you see, 5 or 6 of any particular candles in a row, generally you don't want to be trading against that move because it's very difficult to make those kinds of moves, especially on a daily chart. So what's the general thing? What do we do when we see a Kifu? The first thing we want to do is look at the supporting wave structure behind it. Is the wave structure been broken? In this case, yes. 2, is the price action supportive of it? Well, what do we have here? We have kind of like a double bottom here. We got boom, boom. It's a higher double bottom in this sense. So the second low is higher. And so if we have supporting context, minimally wave structure, but ideally, and the wave structure doesn't have to be broken. It should just be like a failed wave structure. So for example, this wave structure from here to here to here to here wouldn't be broken until this point is taken out, until the C point is taken out. We don't have to have that. But if the Kifu went up to 5 days, went up to here, that would be okay. Why? Because we have a failed wave structure. Not necessarily broken, just failed. It forgot to make a new lows, or not forgot, it just didn't make it. So if we have supporting wave structure and we have a Kifu that is occurring, a bullish Kifu that's occurring at the bottom of a key swing move, or a bearish one that's happening at the top of a bullish move, so a bearish Kifu that's happening at the top of a bull trend, then we should be anticipating that particular move is ending. At worst case scenario, we're going to see a large kind of correction, but that we should be anticipating that move is ending and that the next leg up should be of the same size as the Kifu itself. Now, they were very specific that they said the most ideal situation for a Kifu is that the candles are small. So this would be more appropriate, this kind of size. This is a little less appropriate, so I'm always a little more hesitant on it. But They said basically what you should be doing is measuring the Kifu. So this is the Kifu 1, 2, 3, 4, 5. So the high of this candle, and we should be extending kind of a price measurement. It's almost like a price theory on top of it here. So we should be extending a price measurement on top of it and then seeing, does that price measurement match up with the structure of the price action? And ideally it should match up with the prior two C points in the waves. Now, if we look at the prior two C points in the waves, pretty much. This C point is give or take, I mean, that's not much. It's a difference of 20 pips, 20, 30 pips. So in this case, yes, it does make sense. And so after the first 5 candles, the 5x Kifu, we should be expecting another leg up, a minimally one more leg up, and that should produce a move equal to the same size as the Kifu itself. So this is very handy for us because now we should know or kind of start having an idea of where these Kifu legs should go. You know, how far should they move? And do they match up with some prior structure that works well? And if they do, then we should be looking at this as if we're not in the market, we should be looking to get into it. And if we are in the market, we should be looking to use the Kifu as a potential exit, assuming that, you know, wave structure is being violated, the 5 lines are not looking good, there's other elements that are not looking good for it. This would be a great time for us to be exiting that trade. Now, if you are not already long, what is the general method that Ichimoku theory says in terms of approaching Kifu? How do we trade Kifu? So a 5x Kifu, in this case, this is a 6x. And we'll talk about, there's actually a 7 and a 9, and we'll talk about that in the next video. I feel like it'd be too much if I lay that into this one here because there's a lot more I have to get into in those. But if we get a 5x Kifu, so they are often expecting that within the next 1 to 2 candles, we should be seeing what we call, in this case, if we get a 5x bullish Kifu, we should be expecting a bearish intercept. A bearish intercept is basically a bear candle after a Kifu move that kind of intercepts it. It kind of interrupts that particular Kifu pattern. And if that bearish candle is not super disturbing, what do I mean by that? So here's the measure of the Kifu. If the bearish candle that intercepts it is not something that like takes out like the last 3-4 candles of the Kifu, then that would be kind of the first pause of momentum from the Kifu itself. So we have a double bottom. Bulls are sneaking in slowly. They're really kind of pushing against the bears here. Not all the bears have gotten in. Maybe some bears have their stops just above this key swing point. And so there's some bears who are alert that, hey, this is reversing, but it's not super, it's not going to be, the Kifu is never going to be the biggest leg in a reversal because there's a lot of accumulation. There's a lot of changing of hands. And there's a lot of building up of longs in the very beginning stages, but not everybody's on board. So never expect the first leg of Kifu to be the biggest leg in the move. It should never be. Or it should never be the largest move. Ideally, it's not the largest move available. So with that being said, generally price action Ichimoku traders are looking for a bearish candle and a pullback to kind of use that as an opportunity to get long. It's like, okay, these bulls have reversed a little bit. They've probably taken some profit. Anybody who got long here has definitely taken some profit. And so this is kind of a pause. And they use this kind of pause, or they're looking for a 1, 2, or 3 candle pullback, ideally into some sort of line. And that could be, in this case, it would probably be a Tenkan. Most likely it wouldn't be a Kijun, but it would probably be a Tenkan that's reversed. Or if there is a Kijun and it pulls back to a Tenkan and Kijun, and instead of treating those lines as resistance, which you would do if you're below the Kumo, if they start treating them as support, then we would be looking at those as opportunities to get long. And we would be anticipating that the market would move the full length of the Kifu itself. The general rule is that even if you are getting long somewhere, right around here, let me put this up here. In fact, let me make, is there a way I can copy that? No, that would have been cool. All right, let me make one more, and then I'll... One, two, three, four, five. Oh, I got this right. Move this one down. Okay. So the general rule for a Kifu would be that the move should not retrace the entire Kifu. It should not retrace the entire Kifu. And they've kind of really hinted at saying like, hey, look, you shouldn't see a full 100% retracement of a Kifu. Therefore, you should have a stop pretty much just a little bit below there. If you're getting in on a pullback, say here, or if there happen to be a deeper pullback, maybe even one to right here. In terms of a wave structure, this would be an A, B, C, and we're basically looking to get back towards the low point of the C. It's a more aggressive entry for the C point here, and it should be a shallow pullback. It should not be a deep one. So we're looking for a pullback to some sort of supporting line, either the Tenkan and the Kijun. It could even be a Kumo, but that will be rare. And then we're looking to get long for targeting the full movement of a Kifu. So we're actually, when you think about it, if you're getting in about here, you're really getting about 100 and anywhere from 110. I've seen all the way up to about 130, 140, 150% move of the entire Kifu. So it gives you a favorable plus R ratio. It's not huge, but it gives you a favorable one. And so that is one potential option there. Generally, I have seen very few of the Kifus that have... Most of the Kifus I've seen that kind of qualified with wave structure and context, they just didn't make it to the full bottom here. It's pretty low chance that would happen. And so, yeah, you have a favorable R ratio, and it's also a great indication that, hey, this is just... They're saying this is the minimum. If we see continual kind of Kifus manifesting, and we'll talk about a 5... Well, if we see another 5 manifesting, then they would anticipate, as long as it's not some super giant candles like this, then they would expect a third leg. And, you know, there's even 7 and 9, which we'll talk about in later videos. So we can expect at a minimum these moves, but we can sometimes expect other legs up. And as we can see from this move here, look at this. I mean, this is a large sell-off. You know, 112 down to parity. And the Kifu is the first real thing that indicates the first major reversal. I mean, this was the largest reversal in the entire move, and it was preceded by Kifu. So let's see here. Just going over my notes on what else do I want to talk about. Okay, yeah, this is an important thing. So the most out of all the examples, and they showed dozens and dozens of charts of Kifu, the most common examples I saw of Kifu was just like this. You know, it was a double bottom with a slight adjustment. You know, it was either like a higher low or a slightly lower low, where like the second low was like this. But usually, I would probably say 60% of all the Kifu examples that they showed that they gave examples of had some sort of double bottom type structure. So that should kind of be like an extra hint, like, hey, there's a good chance this is reversing. Now I'd like to show you a couple other examples of Kifus that I had spotted just even on the Aussie Kiwi. Okay, so here's another pretty interesting example of a Kifu right here. So what do we see? We see, I mean, this is kind of, we have a bear here. We actually have 2 examples of Kifus here, but I'll get into this one first, and then we'll talk about structure. So if you look at the major structure here, you kind of see a large corrective structure, for those of you who know the terminology. And we definitely see some failed wave structure here. So we already have failed wave structure. This is a large correction. I mean, this is, you know, 6 months of the pair just kind of going nowhere, stuck in a 500 pip range. And what happens, we start to make some higher lows in this process. And so, you know, we kind of have if we zoom back out, we have an A, B, C, D. This takes out this prior C point, so now we have failed wave structure. This point right here fails to make a new low. So we're definitely seeing some bottoming attempts here. And we can kind of see an A, B, C. You can kind of do it this way, either way you want to, A, B, C, D. But look at what happens towards the bottom of this kind of corrective structure. In fact, it's even a little bit higher. So we make a higher, we break out of the prior sets here. We make a higher high, higher low, and then look what happens here. We have a pretty strong pullback, mostly red candles, probably 60% red candles. And then we see kind of a textbook Kifu here, small bull candles, 1, 2, 3, 4, 5. And so when you start to measure, you say, okay, let's pull out the measuring tool. We measure the bottom of the Kifu to the top of it. And that would be here, I think. 1, 2, 3, 4, 5. Yeah, that's it. Okay, so what do? We stack it on top of it. And does it match up? Matches up pretty well with this right here. This is a prior kind of swing point. So we would be expecting that when this thing ends, that it should make it minimally towards this kind of section here in the top of this Kifu here. And so again, we're looking for a kind of, let me extend this out. What are we looking for? We're looking for kind of a weak corrected pullback or some sort of bearish intercept. We get one here. In fact, if I put a line here, I'm not sure if there was a... We'll just go with that for... I hate the standard colors that they put in there. It's not my favorite. So I apologize. So I'm making you sit through this. I've had my Ichimoku colors relatively stable since 04. Okay, so where are we? So what do we see? What do we see here? 1, 2, 3, 4, 5. And so by this point, the Tenkin's already turning. The 6 bar is hitting the Kijun, and we just kind of just clear the Kijun. So we have supportive 5 lines, and we kind of have the Kifu structure in place. The overall wave structure is building, and so we'd be looking for some sort of pullback here. Now this one doesn't quite get there, but it hints to you, hey, this thing does make it full length of the Kifu. And as we'll get into the next video, we can talk about how you should expect this to actually produce a third leg. And it ends up doing that. It kind of produces a whole new third leg up before it finally reverses. So that's another example of a Kifu. It was kind of a textbook Kifu in this aspect. Another one I had was January 14 was the same thing. Yeah, almost a similar structure. Kind of a double bottom. Same thing, kind of a failed double bottom. So in this case, it's a lower low. What's the price action leading into it? Heavily bearish. Heavily bearish. 115 down to 105. 1,000 pip move. So we have A, B, C, D. Okay, so this would be the D point. And then we're kind of correcting. We bounce and then bounce again. Can't even close below it here. So what happens? 1, 2, 3, 4, 5. Now this is a little interesting. This bar is almost a little too big for my kind of Kifu standards. They kept talking about how Kifu should be small bars. They should be small. They should be more like this size. This is really too big to really kind of say, hey, this is a Kifu. It's just a little too big in my taste. And I don't remember seeing any of their examples having a bar kind of that just eclipses several others. This one bar should not eclipse all the Kifu, really, if you think about it. So, but we didn't see any lower low since then. And it was supported by a wave structure. Another failed. In fact, we kind of have a larger double bottom here. Lamentably, we didn't get one here. But we didn't even see this bear trend ended. 1,000 pip bear trend had ended at that point. We retraced 700 of the 1,000 pips, 70% of that. October 2013 was a really good example of a bearish one. And this is with supportive context. So same thing here. What do we see? Again, massive bear trend. A, B, C, D. And then we kind of get some bottoms here. We start to correct a little bit. Let's kind of map this corrective structure out. So let's just kind of extend this out. Okay. Now, what do we see here? We have a corrective structure. We have a failed wave structure in this aspect, so we should be expecting some sort of reversal. This Kifu, actually, I think there's 2 Kifus inside. 1, 2, 3, 4, 5. So we have one there. And I think that one did make it the 3, 4, 5. Yeah, it ended up making the full length of the Kifu. And it stalled shortly after. But look at the overall, we still have a lower high here. And so in terms of this leg up, what is it interrupted by? 1, 2, 3, 4, 5. 2, 3, 4, 5. So, same thing. Measure it top to bottom. And we should anticipate a move of equal size. And look where it matches up with. Matches up with the structure and context. So we should be looking for, again, a pullback and then looking to sell that down. And we never even come close to retracing the full thing. Now, if somebody was really kind of savvy, they'd be saying, look, this is now kind of the swing point. If we break below this here, then what do we have? An A, B, C, D. So we should be expecting a pullback. And this is kind of like a textbook pullback to structure. We should be expecting a whole new set of legs down. And look what happens then. This is the largest leg inside, all these other prior legs. This is 2 times the length of that. In fact, I almost even think I think it actually produces a move almost double the length. Close, not quite, before it bounces. So that is an example of a bearish Kifu. After kind of it would be a smaller Kifu because it's a smaller move inside a larger trend. But that would be an example of a bearish Kifu. Okay. Anything else I want to talk about? Going over examples. We've gone over the concept of 5x Kifu. We've gone over the concept of intercept line. Context is important. And when I say context, I'm talking about the context of the price action around it and the context of the wave structure. We're not looking at 5 lines. We're just looking at context of wave structure and price action. So that's what they're talking about. They never once mentioned the 5 lines in the entire chapter where they're talking about Kifu. Anything else I want to say about this? Okay, that is, we're at about 30 minutes. I kind of like to wrap it up here. I'll actually introduce the concept of limit line in the next one because that kind of goes into a whole new section of stuff when I talk about Kifu, or I talk about price action there. So the next one we'll talk about limit lines. We will talk about types of, we'll talk about a 7x Kifu and a 9x Kifu and what those mean, because they mean slightly different things. And the 9x Kifu is actually slightly different. You also notice the number 9 in there. And we're even going to get into some time stuff as well, because we'll be talking about how how one period kind of fits into this whole thing. That's a little more advanced stuff, but we'll do that in about a month. So take some time, practice with it, apply it on the daily charts. Just see if you can spot some of these on other pairs of instruments, see how it works out. Also, just kind of ask yourself the general question. Look at the times on the chart, and it could be on any time frame, where you see 5, 6, 7 candles all of the same color in a row. Did you generally want to be trading against that move? Most of the time you didn't. In fact, most of the time you wanted to be trading with that move. So the underlying, kind of intimation by Kifu is it's a pretty straightforward thing, and it makes sense intuitively. So take some time, practice with it. Just 5x Kifu, see if you can spot some potential reversals, see if you can, do the price measurement and everything like that. Just play with it a little bit. And then in the next video, we'll get into 7x, 9x, and limit line and how it relates to time. So with that being said, I hope you enjoyed this video. Pretty exciting to me stuff, because we're really talking about stuff that really, I couldn't find anything out there like publicly on the internet or anything like this. It was all from the book that we've had translated. So Just super exciting stuff and super interesting stuff for me because it kind of rang true for something that, I've been thinking about since 2011 when I talked to that trader. So with that being said, I look forward to your comments and questions, and I expect a lot of them, and it'll take some time to work on this, but that's okay. Be patient with it. And you can use it to either get into the market or you can use it to get out of the market in terms of existing moves you're already in. But there is definitely a value in this, and it gives us a very kind of fresh, interesting perspective about Ichimoku. So I hope you enjoyed it, and look forward to your comments, questions on this, and I'll see you inside the course.